Greetings traders and welcome back to today's video. We're continuing our exploration of quarter theory, a straightforward model designed to help you identify high probability trading opportunities. This video is part of our ongoing high probability trading zones playlist on YouTube. If you haven't watched the previous videos in the series, I highly recommend checking them out. They will provide you with essential insights into identifying market bias, and quarter theory will guide you in acting on that bias effectively. Right. Another thing I'll do is for you guys on TradingView, I will attach those videos to this video, so you will find them in the video description. All right. But with that being said, let's get into it. Okay, cool. So what we'll be doing today concerning quarter theory, just to give you guys a bit of insight on what I'm thinking, is that in today's video we'll focus mainly on the daily time frame in relation to the M15. So this will be for intraday traders. You'll notice the video I did 2 weeks ago focused mostly on us looking at the weekly time frame against the hourly. So that was more for swing traders, right? So today, like I said, is mostly for day trading. So if you're a person who likes trading the M15 and lower, this is for you. All right. So now just to give you guys a brief introduction on things, all right, on quarter theory, we understand that it is the study of algorithmic price delivery within the markets. The market is delivered or priced by an algorithm called IPTA, which is the interbank price delivery algorithm. Therefore, its patterns are repetitive and fractal. And that's one thing we understand about the market, that it is very repetitive and very fractal, right? Now, when we're looking into day trading using quarter theory, what we're going to do instead of what we did 2 weeks ago, where we looked at, you know, Monday to Thursday and we're separating these days, right? When we look at day trading, what we do is we separate the sessions. So we understand that there are 4 trading sessions within a day. And if we looking at quarter theory, it suggests that you divide the day by 4. You divide it quarterly. And once you start doing that, you start to discover that each session will operate for 6 hours. All right. So what that means is Asian session has its own 6 hours, London session has 6, New York session morning has 6, and then the afternoon New York session has 6 as well. And all of that makes up the 24 hours within a day. All right. So that's very important to note because um, we'll then look at the reference points when we studying the quarter theory idea or how the algorithm delivers a candle, a bullish candle. There are three different ways or 3 different models, right? But before we get into the model, what I want us to do is I want us to look at this daily candle. Now, what we're going to assume is the price action before this bullish candle is bullish, right? That's what we're going to assume. In order for you to really, you know, have this model work for you, you need to understand where the market is drawing to. So that's why the first 2 videos in the high probability trading zones playlist focus just on bias. So you need to have an idea of where the market is most likely going to draw to next. Once you have that idea, quarter theory will guide you in acting on that bias effectively. All right. So the information prior to this candle is bullish, and we're going to assume that this candle hasn't printed yet. All right. How would this candle print? So this is just candle anatomy. The first thing that happens is the open of the candle occurs. Now, if you're anticipating bullishness, what tends to happen most of the time is after the open, you see the market push towards the downside to set the low of the day. After the low has been set, you will see a heavy distribution of price action towards the upside to set the high of the day. All right. At this point, once the high of the day has been set, the algorithm will look to sell off the buy positions it had entered over there. It will sell it off at a premium against willing sellers. No, willing buyers against buy stops. So once they start selling off their positions, that's why you start to see them. the candle push towards the downside a bit, or you get a bit of a retracement, then you get the close of the candle. So that's just candle anatomy, right? Now we want to study this candle on the M15. How can this candle unfold? And how can we take advantage of that? There are three different ways that this candle can most likely unfold, right? And that's the model. This is quarter theory. But before we get into that, the first thing you need to note is reference points and times, right? The first reference point you need to note, and you do this every day on your chart. The first reference point is at 6 p.m. New York time. Always use New York time, right? Then you want to get a 6 hour span. So at 6 p.m. New York time, that's when your Asian session will start. There'll be a 6 hour span until 12 a.m. New York time. That's when Asian session is done trading, right? That's your first quarter. Your second quarter is London session. It opens at 12. So you want to have a line over there, 12 a.m. until 6 a.m. New York time. That's your 6 hour span for London session. Another point, New York session opens at 6 to 12 p.m. That's your quarter three for New York session. From 12 p.m. to 6 p.m. New York time, that's your fourth quarter, which is your New York session afternoon. That's when Asian session opens again, and then the cycle starts over here again. So the thing moves over and over. It does this, you know, like I mentioned earlier, we speaking about repetitiveness and this idea of fractalness. So it always occurs each and every day, every time frame. Right. So those are your reference points. Q1 is your Asian, London, New York afternoon. Right. Now, once you have those reference points, at 6 p.m., this is where the candle opens. That's where the candle starts printing. All right. That's when Asian session starts. The other rule you need to note is that you do not trade Q1. There's no trading at all in Q1. You don't trade Asian session. You wait for Asian session to play out, and you only trade Q2, Q3, and sometimes Q4, right? But what's very important for you to be taking advantage of is Q2 and Q3. So you don't trade Asian session. You wait for Asian session to play out. Once 12 a.m. hits, this is when London session starts. You mark that point. This is your true open. True open of the day occurs over here. That's when London session starts. Now, why don't we trade Q1? The reason we don't trade Q1 is because Q1 sets the tone of what we can anticipate for the rest of the day. How will the market unfold? So once Q1 is played out, at this time you want to ask yourself this question: what type of price action did Asian session give us? Was it a cumulative price action, or was it trending in nature? We can note this and we can clearly see that this is a cumulative price action. The moment you see that this is a cumulative price action, you denote it as Q1 has been accumulating. All right. And immediately that will give you model one, because model one is the only one that has accumulation as Q1. Now, what do you anticipate in Q2? You anticipate manipulation to occur. If you're anticipating bullishness, right, then you anticipate the manipulation to be towards the downside. If you're anticipating bearishness, you anticipate the manipulation to be towards the upside, right? So in this instance, we know that we're anticipating bullishness, so we want the manipulation, or we're anticipating it. Let me take away that want, because it gives you some type of expectation over the market. Always react to what's occurring, right? So we wait for that to occur, the manipulation. The next question is, why does the manipulation occur? Here's why it occurs. But why is it also called the Judas swing? The reason why the manipulation is called the Judas swing is because ICT makes reference to a farmhouse or a farm place, whatever, where you have sheep. One of those sheep is called Judas. The reason why it's called Judas is because it leads the other sheep towards the slaughterhouse, but before it gets to the gates or the doors of the slaughterhouse, that sheep turns around and all the other sheep go through and they get slaughtered. That same narrative is what's occurring over here. The algorithm pushes price action into further discount prices as to take out all of the sell stops that exist up down here, right? What are these sell stops? Note this. This is a nice support zone, which means that traders are most likely accumulating long orders over here, and their stop losses exist where? At these lows. Those stop losses are regarded as sell stops. They're regarded as willing sellers. That's what the banks or smart money is looking at your stop losses at as. They're regarded as willing sellers at a discount price to buy against. So the algorithm pushes price action, meaning the algorithm sold here, smart money sold, right? Smart money dictates where the market is going. It's not us as traders. So they sold price action over here. What occurs? You get a break of structure. Immediately when you get a break of structure, us as retail traders, we say this is a nice retest. Let's sell it further. And we do that. And the algorithm itself sells this point, hence the market pushes even lower. We don't know that we're being manipulated. We don't know why this is occurring. The reason why it's occurring is the algorithm is pushing price action into discount prices. They see that there are sell stops, willing sellers at a discount price to buy against. Banks need to buy at proper discount prices, or if they're selling at proper premium prices. I've done this video or a video on this, the first two videos on high probability on the series, basically. Right? So they want to push price action into a discount, right? They need to buy against these sell stops so as to not experience slippage, right? So they need to buy against liquidity. So that's exactly what's occurring over here. So as the result of this manipulation then results in price having to set the low of the day, and then they buy this and price pushes towards the upside. Your job now as a trader is to make sure that you're always looking to buy after the manipulation has occurred because you're buying against sellers. These are everyone who's being manipulated here is going to be seen as willing sellers to buy against. So after confirmation, you buy there. I mentioned this earlier. I said at this point, the algorithm or smart money sold as well. They have the liquidity to hedge the market. They bought at this point, which resulted in price action having to push towards the upside. Their sell order over there is now in loss. So what will they do? They'll bring it back over here so as to mitigate that sell order and to reinstate new buying over here, which will push the market even further towards the upside. That is support and resistance, and that's why support and resistance works. It's the algorithm, it's smart money. They're mitigating their orders. That point will be regarded as a breaker. That's another point where you can look to buy the market. So after that, New York session steps in. What do you anticipate? Further bullishness towards the upside. You anticipate distribution towards the upside so as to set the high of the day. After the objective has been met, what will occur is during the fourth quarter, if the objective hasn't been met, you'll get a continuation of price action. If it has been, then you'll get a reversal. So that's what the X is. But you have multiple opportunities. Here's a break of structure, price retests it, another opportunity to push price action higher. These two, the manipulation and the distribution, will always be your high probability trading zones. It's less green over here, so it's not as probable, right? Another thing you need to note as well is in Forex, once 12 p.m. hits, you get less volatility during the New York session afternoon. But if you trade indices, it's very important for you to be trading New York session and the New York session afternoon. I only trade New York session afternoon uh, right now at the moment, right? Because I'm busy during the day. And in indices, you get heavy momentum during these two sessions. But let's go on to the next model. We'll move a lot quicker now. Same candle, but it can unfold in this manner. Remember, let Q1 play out. You ask yourself the question, what type of price action is this? Is it accumulative? Is it trending in nature? If we're seeing bullishness, this is a reversal against that bullishness, so we denote it as an X, right? We wait for Q2 to play out now. In this instance, we see Q2 playing out. In this instance, we see that Q2 is accumulative. You don't trade accumulations. That's your rule. You don't trade accumulations as well. You don't trade Q1 and you don't trade accumulations. Then, if you see that you get an XA, then immediately understand that you're going to be anticipating or seeing model 2, which is XAMD. Meaning what? You want to prioritize doing what? Trading the manipulation and the distribution. That's your high probability. So what do you see? Once 6 p.m. hits, you're anticipating a manipulation of price action towards which direction? The manipulation should always be against the intended move towards the upside. So in this instance, that's your due to swing. This could even have gone even further as to take out those sell stops, right? It all depends on the market. As long as the manipulation has occurred, you see a low has been taken out. Your job is to then look for a confirmation. That's a break of structure over there. What is that? That's a breaker or a mitigation zone over there, or mitigation or breaker block, right? You understand that the algorithm is drawing price back here, so you can look to buy this, right? So that's your high probability over there. You're anticipating a distribution in the fourth quarter, meaning what? You're anticipating a continuation of price action so as to set the high of the day. And then eventually what happens is you get the close, right? So this is model 2. Let's go on to model 3. Now this model, right? This model is the most common model you'll ever see within the market. Model 3, XXMD. Same candle can unfold in this manner. You don't trade Q1. Ask yourself the question, what type of price action is this? It's a reversal type of price action denoted as a X, right? Now, here you can have a trade. You can trade the X, but you can see that it's less green, right? You can trade the X provided that Q2 takes out Q1 or Asian sessions low. We understand that sessions have a large amount of liquidity as well. So if Q2 takes out Asian sessions low, the sell stops over there, and then you get confirmation. What is confirmation? You get a market structure shift over here, another break of structure over here. You get a pullback to where? A breaker, right? You understand that the market has mitigated the sell order over there that the banks had initiated, and what are they going to do over here? They're going to reinstate new buying, which will result in further bullishness towards the upside. So you have a trade over there, but you know that your high probability trading is going to be between these two over here, meaning what? Q3 will you'll now anticipate your manipulation, and then Q4 you'll anticipate your distribution. Your manipulation occurs over here. You just want a low to get swept. Price can even go further as to sweep all of these lows. It doesn't matter as long as the manipulation has been taken. What does the manipulation mean? It means that the algorithm has pushed price action into a bit of a discount price to take out all the sell stops that exist at that said discount price, and they're going to buy against those sell stops to push price into a further premium to then sell off their order to willing buyers at a premium. So that's why you then see a heavy momentum towards the upside. Distribution occurs in the fourth quarter. High probability trading over here. So here you have a trade. You get the break of structure over there. Price pulls back, right? Entry. What occurs over here? Heavy distribution. If there's still a draw towards the upside, meaning there's buy stops at a premium, what you'll anticipate is further bullishness until prices reach that point. Once prices reach that point, the banks will then sell off the buy orders that they had initiated over here. They'll sell them against the willing buyers that exist at this point, right? They'll sell off their orders over there at a premium, and then that's why you'll start to see a bit of a retracement, right? And then you'll get the close of the candle. I hope this makes sense. So now my thinking is we just did content in this video, focused mainly just on content. And then the next video, what I'll do is I'll just focus on real market practical examples by just showing you this whole thing. So what I'd like you guys to do is take this information and go into the market, use these reference points, and try and find, the narrative, or try and see this. And another thing you can do is you can look on a daily time frame and see, okay, this is a bullish candle, and then just go back in time and then try and see how that bullish candle unfolded. That's how you learn, right? But with that being said, best regards, the architect.